Hello and welcome to Quarterly Perspectives, Fourth Quarter 2019. My name is Justin Rice and I serve as one of the financial advisors at Personal Wealth Strategies, and I'll be your host for this presentation. The presentation is divided into two parts. The first part reviews recent asset returns, and the second part looks at recent market and economic headlines. We start our return discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, U.S. international and emerging market stocks were solidly higher in the fourth quarter. U.S. bonds gained a little, and global bonds declined. Let's look a little deeper at what was driving the returns of stocks and bonds. We start by looking at how developed stock markets performed over the past 12 months. Which is the return for 2019. We can see a wide range of results, which speaks to the need to diversify. While it would have been great to have all our money invested in New Zealand, the best performing country this year, investing in only one country introduces the possibility that all of our money could have been invested in Finland, the worst performing country. The dots on or near each country's bar represents how the local stock market performed over the past 12 months. A similar trend with an even wider range of returns occurred in the stock markets of emerging countries. Russia had the best return in 2019, and Chile had the largest decline. Our evidence-based investment process has us favor several factors of return. One of those factors is a preference for small companies versus large companies. History has shown that small companies tend to outperform large companies over the long term since you're taking on more risk. Looking back over the past 5 years, we see that outperformance in international companies, but we didn't see it in U.S. and emerging market companies. Another factor of return we emphasize is on value companies. Historically, value companies have outperformed growth companies over the long term. On these charts, when we see the lines going up, value outperforms growth. When they head down, growth outperforms value. Over the past 5 years, and illustrated on the graph to the left, we can see that large growth companies outperformed large value companies in every category. On the right-hand side, we look at small companies and see that only emerging markets small value companies have done well versus small growth companies. We also see that U.S. small value and international small value companies had periods when value outperformed and periods where they didn't. While we expect our factors of return to always deliver positive results, realized returns are often different. This is why we diversify into multiple factors of return. Turning our attention to bonds, we start by looking at recent interest rates. Here we plot what is commonly referred to as a yield curve, to show us how much interest we receive from bond investments with different maturities. The green line represents interest rates at the end of 2018, and the blue line represents interest rates at the end of 2019. Since the blue line is lower than the green line, we can see that interest rates decreased during the year. Bond prices rise when interest rates fall, and this helped boost bond results for the year-to-date period. We typically prefer investing in bonds that have shorter maturities and higher quality than the broad bond market. In the chart on the left side, we see rising interest rates hurt longer maturity bonds during the fourth quarter. Yet interest rates fell for the calendar year, so the year-to-date results are positive. In the chart on the right, lower credit qualities performed better than higher credit qualities during the quarter and for the year. On this slide, we look at the absolute impact of different asset classes on a sample 65% stock, 35% bond index mix. With both stock and bond markets advancing in the quarter, we can see that almost all asset classes added to the overall gain. U.S. real estate investment trusts were the only detractor this quarter. Looking at year-to-date asset class returns, we see asset classes in your portfolio ranging from a positive 31.5% for U.S. large companies on the high end to 2.3% for cash on the low end. Maintaining a diversified asset mix, such as the 65% stock, 35% bond example shown in white, kept us away from the more extreme returns from year to year with significantly less volatility over the last 15 years, highlighting the importance of maintaining a well-diversified mix of asset classes in our portfolios. Let's turn our attention to some of the major stories we saw in the most recent quarter. New information comes out daily, potentially impacting the direction of individual companies and the overall market. While this collection of headlines isn't meant to explain why the global stock market returned what it returned, we present it to help illustrate that there is a lot of short-term news that might tempt us to make an investment decision we may regret. It is wise to stay informed, but we feel it very important to keep a long-term perspective when it comes to investing. The one quote that we want to highlight is the last one, that states U.S. stocks gained 190% during the past decade. On the following slides, we'll see this performance in a historical context and review other asset classes from a long-term perspective as well. Over the past decade, the U.S. stock market was the strongest of all the developed non-U.S. markets and emerging markets. While the majority of countries posted positive gains in dollar terms for the decade, there were still 10 countries that posted negative returns for the decade. We don't have to look back too far to see a negative decade of returns for the U.S. market. The U.S. stock market experienced a lost decade in the 2000s, and while the returns for U.S. stocks were impressive over the past decade, it was only the fourth best decade from the past 9. This is an interesting chart that shows the best investment theme by decade. What you notice is that in each decade after World War II, there is a different theme that dominates the financial landscape and has a far superior return than any other sector. The 2010s was really all about America, specifically large technology stocks. However, if we leave out the most recent decade and just take those 6 investment themes of the past decades, we can view their performance in the immediate next decade. How did they do? Was one decade of prominence a good predictor of how they did in the next? Actually, it has been, but not in the way you may think. In fact, the median performance of a hot trend in one decade was a negative 11% in the following decade. This shows us that we can't extrapolate based on what's happening in just one decade. And although we can't predict the future, this could be a concern looking forward at the performance of American companies, specifically large technology companies, which was the hot sector in the most recent decade. The message here is not to avoid investing in those companies going forward, but instead to remain globally diversified. We must remain disciplined and avoid the temptation to chase the best returning sectors of the previous decade. As mentioned earlier in the presentation, our evidence-based investment process has us favor small companies over large companies and value companies over growth companies. While the return of small value companies has historically outpaced that of large growth companies, the outperformance isn't guaranteed. In fact, large growth companies, which include the American technology stocks we were just discussing in the last 2 slides, beat small value companies over the past 10 years. Yet, even when we add the recent outperformance of large growth to our long-term numbers, we still see that small value companies have outperformed large growth companies over the long term. Looking at bond performance over the past 9 decades, we see that total returns have continued to decline from the strong returns investors received in the 1980s. We expect this trend to continue being in such a low interest rate environment. Now let's look at 2 near-term headlines that may shape this decade. We start with some highlights of the recently approved SECURE Act, setting every community up for retirement enhancement. This act is the most comprehensive change to the retirement area for both individuals and employers since the Pension Protection Act of 2006. Some of the rules we've become accustomed to for our retirement accounts have now changed. For example, IRA owners can now continue contributing to their IRAs past the age of 70 and a half. The age you're required to take required minimum distributions from these accounts moved from 70 and a half to age 72. For inherited IRAs, a non-spouse beneficiary must now withdraw all the funds over a 10-year period instead of the beneficiary's lifetime. These changes mentioned and others in the Act may impact parts of your financial plan, so be sure to talk with us if you have any question about these changes. And finally, this year's presidential election will continue to make headlines. From an investment perspective, we'll also see a good deal of analysis, like this graph that shares how stock returns may be impacted by presidential term. On average, an election year has the second best overall return in the U.S. stock market when compared to other presidential term years. While we find these types of observations interesting, they usually aren't too informative, as they are based on small sample sizes and can easily be negated by geopolitical or economic trends. This concludes our presentation for today. Thank you again for joining me. We'll talk to you again next quarter.